There is a moment in American history that almost no textbook bothers to explain. A moment when the United States government, the most powerful institution on the planet, ran out of options, ran out of gold, and ran out of time. And the only man who could save it wasn't a president, wasn't a general, and wasn't elected by anyone. He was a private banker, and he was going to charge for the privilege. His name was John Pierpont Morgan, and what he built, and what he saved twice, was nothing less than the financial architecture of modern America. To understand J.P. Morgan, you have to understand the world he was born into. It was 1837. America was young, chaotic, and financially ungoverned. There was no central bank. There was no Federal Reserve. There were hundreds of small state-chartered banks, each printing their own currency, each making their own rules. The system crashed roughly every decade, wiping out farmers, merchants, and ordinary workers who had done nothing wrong except trust the wrong institution. Morgan grew up watching this dysfunction. His father, Junius Morgan, was already a powerful banker with deep connections to London's financial elite. J.P. grew up inside a world where money wasn't just currency. It was architecture. The man who arranged the loans, set the terms, and held the paper was the man who quietly controlled everything else. He arrived in New York in the 1860s and immediately began doing what he would do for the next 50 years, imposing order on chaos. His first major target was the American railroad system. By the 1870s, the railroads were the most important industry in the country, and a complete disaster. Dozens of competing lines were engaged in suicidal price wars, constantly going bankrupt, constantly reorganizing, wiping out investors with every collapse. Morgan stepped in and did something no government had been willing to do. He forced the railroad barons into rooms together and made them agree to fixed rates and territorial boundaries. He restructured failing lines, replaced incompetent management, and installed his own people on their boards. It became known as Morganization. Critics called it monopoly. Morgan called it rationality. By the time he was done, he controlled or influenced nearly a third of all railroad track in the United States. Roughly 55,000 miles of rail operated under his direction or financial oversight. Not because he had seized it, because he had financed it, and financing meant control. The first rescue came in 1895, and it came because the United States government had driven itself to the edge of catastrophe through a decade of monetary schizophrenia. The problem was silver. After the Civil War, America was legally on the gold standard. Every dollar in circulation had to be backed by gold held in the Treasury. But Congress, under pressure from silver mining states and indebted farmers, had also passed laws requiring the Treasury to buy massive quantities of silver every month and mint it into coins at artificial prices. The result was Gresham's Law playing out in slow motion. People spent the silver. They hoarded the gold. Gold trickled out of the Treasury through the 1880s, and when the financial panic of 1893 hit, the trickle became a flood. Congress had set $100 million as the minimum gold reserve the Treasury needed to maintain the gold standard. By early 1895, that reserve had collapsed to just $9 million. $9 million. The United States government was days away from being unable to honor its own currency. President Grover Cleveland had already tried once to issue bonds to replenish the gold supply. Congress had authorized it. The gold came in and immediately flowed right back out again because investors didn't trust the government's commitment to the gold standard. A second bond issue was proposed. Congress refused to authorize it. Cleveland was out of moves. J.P. Morgan arrived in Washington and asked for a meeting with the president. Cleveland initially refused. He knew what the political optics looked like. The President of the United States going to a Wall Street banker for a bailout. But the next morning, with the Treasury nearly empty, he had no choice. He let Morgan in. Morgan sat down and told Cleveland he had found a solution. His lawyers had located an obscure Civil War-era statute, a law that had been sitting unused in the books for 30 years. That allowed the Treasury to issue bonds without congressional approval, specifically to purchase gold coin. Cleveland's own legal team hadn't found it. The deal was structured as follows. Morgan and August Belmont Jr., the American representative of the Rothschild banking empire, would supply the U.S. Treasury with 3.5 million ounces of gold, sourced primarily from European markets. In exchange, the government would issue $62.3 million in 30-year bonds. And then Morgan did something that elevated the deal from a transaction to a demonstration of raw financial power. He personally guaranteed, using sophisticated foreign exchange techniques, that the gold would not flow back out of the Treasury. He would manage the dollar's exchange rate in international markets to make sure the reserve held. Within 2 months, the Treasury had $107.5 million in gold reserves. The gold standard was saved. The dollar was stable. The crisis was over. Morgan and his syndicate cleared an estimated $7 million to $12 million in profit on the transaction. The public reaction was volcanic. Newspapers called it the crime of 1895. Politicians demanded investigations. How had it come to this? That the sovereign government of the United States had been forced to beg a private banker to rescue its own currency and pay a premium for the favor. Morgan declined to apologize. He had identified the problem, structured the solution, and executed it while the government was still debating its options. That, in his view, was the end of the discussion. He kept building. Morgan wasn't content to simply be a banker. He was constructing something far larger, an integrated financial system with himself at the center. He reorganized railroads. He financed the early development of General Electric. His bank held significant interest in AT&T. His influence stretched into nearly every major industry in America before the turn of the century. And then, in 1901, he made the single largest business transaction in human history up to that point. Andrew Carnegie wanted to sell his steel empire. Carnegie was, by most estimates, the richest private individual on earth. His fortune built on dominating American steel production. He and Morgan met, and Carnegie named his price, $480 million. In 1901, $480 million was an almost incomprehensible sum. It was roughly equivalent to 1.4% of the entire United States GDP at the time. Morgan didn't negotiate. He extended his hand and said, "Congratulations, Mr. Carnegie. You are now the richest man in the world." He then merged Carnegie's operations with several other steel producers and created the United States Steel Corporation, the first company in American history, capitalized at over $1 billion. $1 billion. The first billion-dollar corporation on earth. Morgan's bank was its primary financier. He controlled approximately 60% of American steel production through a single transaction. John D. Rockefeller, whose own fortune at that time exceeded $900 million, heard the details and reportedly said, "The man who made that deal is not a businessman. He is something else entirely." The second rescue came in October 1907, and unlike 1895, this one almost failed. It started, as financial catastrophes often do, with greed and stupidity in a narrow corner of the market. A speculator named F. Augustus Heinze attempted to corner the stock of United Copper, a small mining company. On October 16, 1907, the corner collapsed spectacularly. Within days, banks connected to Heinze began to fail. Depositors lined up around the block to pull their cash out. The panic spread from bank to bank. But the real danger wasn't the national banks. It was the trust companies. Trust companies were state-chartered institutions that competed with banks for deposits, but held far lower cash reserves. National banks kept roughly 25% of deposits in cash. Trust companies kept around 5%. When depositors wanted their money, the trust companies didn't have it. On October 22nd, Knickerbocker Trust, one of New York's most prominent institutions, suspended operations after depositors withdrew nearly $8 million in a single day. The stock market went into freefall. The interest rate on overnight loans spiked from 9.5% to 70% in a single day, then to 100% 2 days later. At certain moments, there were simply no loans available at any price. The New York Stock Exchange was hours away from closing entirely. There was no Federal Reserve. There was no federal deposit insurance. There was no emergency government backstop of any kind. There was J.P. Morgan. Morgan was 70 years old. He had just returned from an Episcopal Church convention in Virginia. His aides briefed him on the situation during the train ride back to New York. By the time he arrived, he had already decided what needed to be done. He set up his command post in his personal library on 36th Street in Manhattan, a magnificent building he had constructed to house his private art collection and rare manuscripts. And for the next 3 weeks, that private library functioned as the de facto central bank of the United States of America. Morgan summoned every major bank president in New York. He called in trust company executives, brokerage heads, and Treasury officials. He organized an emergency pool of $25 million, assembled in under 16 minutes from 14 bank presidents, and had it delivered directly to the loan post at the New York Stock Exchange to keep trading alive. He personally directed which institutions would receive emergency funds and which would be allowed to fail. Then came the night that entered legend. On a Saturday evening in early November, Morgan gathered over 40 of the most powerful bankers and financiers in America inside his library. The crisis had reached its most dangerous point. 2 major trust companies, Trust Company of America and Lincoln Trust, were hours away from failing to open Monday morning. If they collapsed, the cascade would be unstoppable. Morgan divided the men into 2 rooms, the clearinghouse bank presidents in one, the trust company executives in the other, and let them work through the problem. By 3 in the morning, over 120 bank and trust company officials had assembled. Morgan had reviewed the books. He knew which institutions were solvent and which were not. He knew exactly what number was needed. And then he did something that no government official, no regulator, no elected leader had ever done or could have done. He locked the doors, physically locked the doors of his library, put the key in his coat pocket, stood in front of the assembled bankers and told them, in plain language, that they were not leaving until they had agreed to provide $25 million to stabilize the failing trust companies. He told them, calmly, without theatrics, that if the trust companies opened insolvent on Monday morning, the entire American banking system would be in ruins before the week was out. Every man in that room would be destroyed along with it. The trust company presidents resisted. They argued. They stalled. Morgan let them talk. He sat in a chair near the fireplace, playing solitaire, and waited. At 4:45 in the morning, the lead representative of the trust companies picked up a pen and signed. Every other man in the room followed. Morgan unlocked the doors. The men walked out into the November cold. The crisis was over. In less than 3 weeks, a 70-year-old private citizen had done single-handedly what it would take an act of Congress and an entirely new federal institution to replicate. He had assessed solvency, mobilized capital, directed liquidity, and forced consensus, functioning as the entire financial system at once. President Theodore Roosevelt, who had spent years pursuing antitrust cases against Morgan's industrial empire, sent his personal representative to express gratitude. The Secretary of the Treasury issued a public statement of thanks. Congress held hearings, not to investigate Morgan, but to study how a private individual had stabilized a national financial catastrophe faster and more effectively than any government body could have. The answer was straightforward and deeply uncomfortable. He had done it because he had the power. He had the power because no one had ever taken it away from him. And the reason no one had taken it away was that every time the country needed saving, he was the only one capable of doing it. The 1907 panic made one thing undeniable. The United States could not continue to depend on the willingness, and the profit motive, of a single private banker to prevent financial collapse. In November 1910, a group of men boarded a private train and traveled in secrecy to Jekyll Island, a remote barrier island off the Georgia coast. They used false names. They told no one where they were going. Among them were Senator Nelson Aldrich, Henry Davison, one of Morgan's closest partners at his bank, and Paul Warburg, a European banking expert with deep knowledge of central banking systems. They spent a week drafting the blueprint for a new American banking architecture. 3 years later, in December 1913, the same year J.P. Morgan died, the Federal Reserve Act was signed into law. The United States finally had a central bank, a permanent, institutionalized lender of last resort. The panic of 1907 had made it inevitable. Morgan's library had made it necessary. Morgan did not live to see the Federal Reserve open its doors. He died on March 31, 1913, in a hotel room in Rome. He was 75 years old. His estate was valued at $118 million. When Rockefeller heard the number, his own personal fortune was estimated at over $900 million at the time. He was reportedly silent for a long moment. Then he said, "And to think, he wasn't even a rich man." Rockefeller was technically correct. Morgan's personal wealth was modest compared to the great industrial fortunes of the Gilded Age. But that comparison misses the point entirely. Morgan was not an industrialist. He was not trying to accumulate assets. He was the man who financed the industrialists, the man who held the paper on their empires, the man who decided which railroads survived reorganization and which were liquidated, which banks opened on Monday morning and which did not. The story of the House of Morgan did not end in 1913. His son, Jack Morgan, inherited the firm and took it to a new theater of operations, the First World War. When war broke out in 1914, Britain and France needed American supplies: steel, wheat, ammunition, horses, everything, and they needed financing to pay for them. Jack Morgan became the exclusive purchasing agent for the British and French governments in the United States. The contract covered over $3 billion in supplies. The firm's commission was 1%. That was $30 million. In 1915, Jack arranged what was then the largest foreign loan in Wall Street history, $500 million to France and Britain, syndicated through over 2,200 American banks. The money kept the Allied war effort operational through the darkest years of the conflict. Some historians have argued that without the Morgan loans, Britain and France would have been forced to the negotiating table by 1916. The outcome of the war, and everything that followed, might have been entirely different. By 1917, the Allies had exhausted their credit. The Morgan loans were at risk. The United States entered the war. Whether the financial exposure shaped the political decision is a question historians have debated for a century. What is not debated is the scale of the House of Morgan's involvement. At various points, the firm had financed both sides of wars, restructured entire industrial sectors, rescued the United States Treasury, and quite literally locked the door on the most powerful financiers in America until they agreed to terms. The actual lesson inside the House of Morgan's story is this: the most powerful force in modern civilization is not armies, it is not governments, it is not technology, it is credit, the ability to create it, direct it, and withdraw it at will. The man who controls the flow of money controls who wins wars, which industries define eras, and whether governments survive their own crises. J.P. Morgan understood that before almost anyone else. He did not build railroads, he financed the men who did, and then took control of the railroads when those men failed. He did not manufacture steel. He bought the man who did for $480 million and turned it into the first $1 billion corporation in history. He did not design electrical systems or telephone networks. He funded the companies that did and sat on their boards. He was the architecture beneath the architecture, the financial system inside the financial system. And when that system cracked, in 1895, in 1907, there was no government mechanism capable of responding fast enough. There was only one man with a room full of bankers, a key in his pocket, and the nerve to use it. America built the Federal Reserve to make sure it would never need to call him again. It is worth remembering what that admission actually means. The most powerful government on earth, a nation of tens of millions of people, a democracy with elected representatives and constitutional checks and balances, decided, after 1907, that it needed a permanent institution to do what one private banker had been doing alone for 40 years. His name was John Pierpont Morgan, and the country you live in was built, at least in part, on his terms.